Okay, hello everyone. Let me try to complete this question for you as a reference. So, this is a very simple question, and it is to do with the trading company. So, let's first of all try to read out the questions, highlighting some of the key information that you need to follow through when doing this question. So, let me read out this question. A trading company, in a process of preparing the master budget, gathered the following information about its assets and liabilities, and also about the past and future sales. So, on this side, as you can see, you're given with the part of the balance sheet, and on your right hand side, you're given with the amount of sales. So, as you can see, these information, the inventory, there are 20,000 units of inventory at the rate of rupees 4, a total of 80,000. Accounts receivable for the month of November and the month of December is 30,000 and 80,000. Total it is 110,000. The cash in hand is 10,000 and the total assets is 2 lakh. On the liability side, there's accounts payable of 80,000. Now moving forward, so we're given with the sales for 6 months. It says that actual and the forecasted sales. Will find out which are the actual ones and which are the forecasted ones. As of now, we can see we're given with the sales for the month of November and December, January, February, March, and April. So all the sales are given in amounts that we can see, followed by the informations like companies' sales are mostly uncredited. Experience shows that 50% of the credit sales are collected in the month of sales and remaining 50% are collected on the following 2 months of the sales equally. So be careful on this, the way the informations are given. So 50% of the collected, 50% are collected in the following 2 months of the sales equally. So sales are to be collected in 3 installments. That the first is 50% on the same month, 25% on the next month, and 25% on the next following month. Bad debts and uncollectibles are negligible. All purchases are paid on the following month of purchase. As you can see that the purchase are to be paid on the month following the purchase. So if you are going to purchase on the month of January, that you'll be paying for that purchase on the month of February, right? So margin on sales is 50%. So this margin means to see the gross profit margin. So this is gross profit margin. Operating and distribution expenses are 30% of the month's sales. Expenses are payable on the month they become due. So all expenses are to be paid on the month when they become due. The company has a policy of maintaining a sufficient inventory of merchandise to meet the following month's sales need. So be careful on this part, that will be useful in preparing your merchandise purchase budget, that the company will make sure that it maintains the inventory that is sufficient to meet the next month's sales need. So whatever amount that you are going to sell in the next month, that you have to have a sufficient inventory equal to that need. And company has a minimum cash balance requirement of 10,000. Moving on, the company has been thinking to buy a computing machine in the month of January, so there is going to be a cash outflow on the month of January for this computing machine that cost rupees 80,000. The company has reached an agreement with the bank for a soft loan of 12% interest. So as you can see, in any month, if the company is not able to meet its minimum cash balance, that is of this 10,000, the company will go to the bank, and it can take the loan, whatever amount that requires, at an interest of 12%. So when taking the loan, company should take the loan in the multiple of 5,000, and the repayments are to be made in the thousands. So every time you borrow, you need to make sure that you borrow in the multiple of 5,000s, and every time you repay at the multiple of 1,000. So you cannot make any payment, which is not the multiple of 1,000 when you are making the repayment. The amount of interest are paid for the loan repaid with the repayment amount to the nearest of rupees 100. So just for the sake of clarity, even if this is not being mentioned, we make sure that we pay the interest on the amount of loan repaid, right? And in addition to that, there is a one thing to note, that whenever you make the interest payment, it needs to be made on the nearest of 100. That is, it should be in the multiple of 100. So with this much of information, we need to prepare this merchandise purchase budget, merchandise purchase budget, uh, the operating expenses budget, the cash received and disbursement budget, the budget income statement, and budgeted balance sheet. So we'll try to cover up these budgets uh, in this video. So let's see. Let's move ahead. So first, let's prepare this merchandise purchase budget. So merchandise purchase budget. So as far as merchandise purchase budget is concerned, I suggest you to take all the cells from the start of the projected period till the end of the projected, like to the till the end of the forecasted months that you're given with. In this case, you're given with the information of 4 months. That is, the start of the projected period is January, and you're given with the informations up to April. So you need to take all the cells up to April to prepare this merchandise purchase budget. So let's do it. So we start with the month of January, then the February, then the March, and then the April. So first thing that we're going to need is the sales revenue. So we start with the sales revenue. We can take this as a format and as also the example to understand how you prepare the merchandise purchase budget. So the sales revenue for the month of January is 160,000. 160,000. On the month of February, it is 2 lakhs. In the month of March, it is 240,000. And on the month of April, it is 280,000. One thing you need to understand is you need to find out the cost of goods sold before you can think of merchandise purchase. So let's deduct gross profit from the sales. As we know, the information that we are given with, the gross margin is 50% of the sales. So whatever your sales amount is, the 50% of that sales is going to be your gross profit. All right, so the 50% of this 160,000 is 80,000. It's going to 100,000. It's going to 120,000. It's going to 140,000. So all of us know, once we deduct this gross profit from the sales revenue, we get the cost of goods sold. That's going to be the remaining amount of 80,000, 100,000, 120,000, 140,000. So the next thing that we need to do is to add the ending inventory. And is to deduct the beginning inventory. As you might be thinking, why we're adding up the ending inventory and deducting the beginning inventory, you need to understand that we are doing the reverse adjustment to the cost of goods sold to find out the amount of merchandise purchase. So this will give you the idea about cost of merchandise purchase. All right, let's get this thing a little bit from here. All right, it's just a moment. Okay, so what is the amount of ending inventory for the month of January? In order to know this, we need to refer to the question and I try to find out what is the inventory policy of the company. Uh, as you can see over here, the company has a policy of maintaining the sufficient inventory of the merchandise to meet the following month's sales. So as you can see, we already have the amount of sales that is going to be made on the month of February, that is 1 lakh. This 1 lakh means in order to make the sales of 2 lakh in the month of February, you need to have the merchandise worth 100,000. Since you cannot take the inventory of the profit, so you take it out from the sales, so you're left with the cost of goods sold. And when taking the inventory, this inventory should be taken on the basis of this amount. So that is going to be 100,000 for the month of January, 120,000 for the month of February, and 140,000 for the month of March. And as you know, the ending inventory of the current month is the beginning inventory of the next month. So what we do is we just write it down back to the next month as a beginning inventory. So this is going to be 100,000. This is going to be 120,000. And this is going to be 140,000. So you might be wondering what is the amount of beginning inventory for the month of Jan. So as I've said, always we need to go to the opening balance sheet, which is this, and for your case, and in this case, you see that the beginning inventory you're given with is 80,000. So that will be the amount of beginning inventory that we'll have it over here. So this is going to be 80,000. And once you adjust this, the amount, then you'll get the cost of merchandise purchase. So what you have to do is you just have to add this ending inventory to this cost of goods sold and deduct this beginning inventory. So we'll find out the amount of cost of merchandise purchase. That's going to be these amounts. All right. So I hope you learn how to make this merchandise purchase budget. So if you're just having difficulty to prepare this merchandise purchase budget, this video will be helpful. And for operating expenses budget, we can meet in our next video. Thank you guys. Have a wonderful time.